Okay, so let's start with this as a test case for us. Now, if you look at this chart of Universal Robina Corporation, you will see a very clear upward path into the movement from 2019. However, the path upwards was not a nice, steadfast line. In fact, it showed quite a bit of choppiness moving up and down several times along that particular swing. And so if you notice all these abilities for prices to be able to move from way up here all the way back down closer to the trend line, these pullbacks in price are called corrections. And they come or they correct because these corrections are there to fix an exaggerated condition with the price. You see in this particular case, it corrected here, 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 and even here. So within a year's time, you're talking about 1, 2, 3, 4, 5, maybe 6, 7 wide corrections that we'd have to be prepared for. It's possible you could just bought this somewhere here and held it through and through. But many times people get shaken out whenever these little pullbacks take place, and because they don't know what to anticipate or to expect during the time that it's pulling back. It's only now in hindsight that you see that the overall trend is still holding. But while that thing is pulling back, you can just imagine what sort of emotions come into your mind when you see these things pulling back, because you might ask yourself, will support hold? How long will this fall? Is this a trend change taking place, or is it just going to be a minor pullback or hiccup? And so a lot of these questions come. And that's why it's really very important we have to understand what are corrections all about? What are they for? And so in essence, a correction comes as a result of prices becoming too extended. So in a case like this, you see very sharp up moves in price here and here. And the conditions that happen there is because the population, who are the investing population, becomes quite excited in buying the stock because they see it moving up. And as more and more people see a price moving up, you get a whole gang of people trying to be able to buy your stock during that period. So it aggravates the upward swing, and it causes that trend to accelerate. But remember, the trend line that you see here, that in blue, this is the way demand is really climbing over time. But if the price is just too far away from that trend line, then something has to give and something has to be adjusted. And that's what we call a correction all about. It allows you to engage some profit taking to put that movement of price back into natural order. And you will understand a bit more of that when I just simply show you this particular arrangement. Okay, so let's start with the basic theme of what the market should try to follow, right? As a rule of thumb, prices must move gradually over time. And we don't mean that prices should streak up overnight, climb up 20, 30, 50% in a single motion. That is abnormal. Normally, it takes time for a stock to climb. And why is that? Well, because remember, the stock price is supposed to be matching whatever the company's performance is doing. It's really all about how well a company is performing. How much earnings is it generating? How much growth is it putting into effect? And if that tells you that it may take time for a company to go from so much earnings to the next level of earnings over time, then you will have a gradual swing up in prices along with that reality. All right? So let's assume that the blue line that you see over here is a typical trend line, and that's the way it should move up gradually over time. So the next statement says any exaggeration of this must be paid for by a correction or an adjustment in time or an adjustment made in price. Now let's try to understand what that means. So if this blue line is the way prices should be climbing, and after people see that prices are climbing and it starts to accelerate way much faster, and it convinces a lot more of the short-term crowd to come buying the stock because of that, you will get an accelerated swing up in price. But remember, this is where the price should be, not up here. And the more you stretch this upwards, it may feel like you're holding two sides of a rubber band and you're trying to stretch it as much as you can. But as you stretch that more and more, you're going to feel greater tension for that to try to withdraw. And it's like gravity into the stock market. And when you get that sense of being too much extended, then that's when the market is going to jump into a need for it to correct. So what will a correction look like? So a correction will look like one of these two, or maybe a combination of these two movements. So there's two ways to fix an extended price. The first way is to make what is known as a consolidation over in time. This is when a stock price moves up and it pauses or it pit stops and it just sidewinds for a while. And it does that over a period of time until it hits the trend line again. This is the way that the market price can start to diffuse the extremely heavy sense of exaggeration that it's managed to do. Now, if it wishes to correct this faster, then instead of going sideways and waiting for the trend line to generate support in due time, the price could actually come all the way back down much more faster and pull itself back down to the trend line faster so that it can fix the need to correct faster and then allow itself to be able to climb back in its normal process thereafter. So this reaction in price is the second type of correction that you will see. So the first is a correction in time, while the second is a correction over in price, because it pulls itself back down in price to satisfy the need to reduce that exaggerated state. And so if you're wondering, why do stock prices go up and down, why can't it just be so much more streamlined? Well, it's because this is it. It's been traded by human beings that cast their emotion in there the whole time. And sometimes they get excited, they buy more. Sometimes they regret it, they unwind some of those positions, and it causes that volatility. But the general trend of the market will prevail. And that trend line that you're looking at, this main trend line, as soon as prices either come back down to it here, or maybe just go sideways to go back here, or maybe even a slight combination of both. In other words, maybe partly sideways, partly in a decline, somewhere in the middle, and it hits the trend line will generate that support that can cast the prices back up all over again. So once the price is nice and fixed, no more need for a correction, then the trend may now resume.